In this second video, we'll be demonstrating a few more of the qualified business income deduction problems, and we'll start and take a look at number 44, which is kind of where we left off in the last video. And in this case, it's found on the bottom of 952, top of page 953. We have Stella Waters, who's a CPA and owns her own accounting firm, reports accounting firm income, qualified business income of $540,000, reports wages of $156,000, and the property used in the business is $425,000. Married filing joint, their taxable income before the QBI deduction is $475,000, and their modified taxable income is $448,000. Determine Stella's QBI deduction for 2018. Well, we have something new here that we didn't have before. And the primary issue here then is the fact that we have a specified service business with her having a public accounting firm. So this is the first time we've had to answer yes to this question about whether it's a specified service business. And because it is a specified service business, that normally initiates some additional tests that we need to look at. And one of the tests we need to look at is her taxable income before the QBI deduction over the upper threshold limit for married filing joint of $415,000? And the answer to that question is yes. So because both conditions are met, it is a specified service business, and the taxable income is over $415,000 for married filing joint, that means that these taxpayers are not entitled to any QBI deduction. So both tests have been met. Specified service business over $415,000, that excludes them from qualifying for the QBI deduction. In 45, however, we have a still more complicated situation where we have a business that is a specified service business again, but we're answering no to this question about whether the taxable income is greater than the upper threshold limit. However, we're answering yes to the fact that the taxable income is above the lower level, the lower income threshold limit of $315,000. Well, that combination of having the income fall within this range of $350,000 and $415,000 and being a specified service business, we now have a new calculation to consider, and it's called the applicable percentage. So before we get into that, let's take a look at the problem in more detail. This is found on page 953, problem number 45, where Ben and Molly are married and will file jointly. Ben earns $300,000 from his law firm. He reports business as a sole proprietor. He has wages for the law firm of $40,000, no significant property. Molly is also employed by a CPA firm, though. Her taxable income is $375,000, and that's all to their modified taxable income as well before the QBI deduction. So the question is, what is their QBI deduction for 2018? Well, again, we have this special situation where the income falls between $315,000 and $415,000, and the business is a specified service business. So in this case, we have this new calculation I mentioned earlier, where we have to determine what's called the applicable percentage. And what this, in its simplified terms, what this means is that this is really 1 minus the reduction ratio that you would have used earlier. So what was that reduction ratio? If you would have reviewed the other problems in the template that I have posted in Blackboard, you will have known that the reduction ratio is going to be in this case, the $375,000 minus $315,000 divided by the range between $315,000 and $415,000, which is $100,000. So if we look at this calculation then, the applicable percentage in more detail, as I said, it's going to be the $375,000 minus the lower end of the range of $315,000, and we divide that into 100,000. which is 415 minus 315. And then we subtract that from 1. And that's the only difference between the applicable percentage ratio and the reduction ratio, is that the applicable percentage ratio is just 1 minus the reduction ratio. And that means that only 40% of the initial QBI amount, the W-2 wages, and the unadjusted basis of qualified property is in play in this problem. That is to say, the taxpayers will only qualify for 40% of the initial QBI amount, the W-2 wages, and the unadjusted basis of qualified property. And that calculation is new to us. We haven't had to deal with that before. All right, so now we calculate then the initial QBI amount, and this is similar to what we've done in the past. So we're going to take the QBI deduction of 20%, like we did before in the past, and multiply it by the income from the business of $300,000. But now we're going to multiply that by the 40% applicable percentage. And that again that's a new part of the calculation for us. So it's 20% times 300,000 and now times 40%, the amount we can actually apply or use. And then we're going to just repeat that process. The method is the same, except now we're going to take our calculations for 50% of the wages. And again, 50% of the wages is 50% times the wages of 40,000, but now we're going to multiply that by 40%, the applicable percentage. And that's 8,000. Then we'll calculate the 25% of the wages plus 2.5% of the unadjusted basis of qualified property, and then that too will multiply by the 40%. And then we'll take the greater of the two. And 8,000 is greater than 4,000, so we'll take 8,000 there. And then again, referring to cells 160 and 163, select the lesser of the qualified business income amount of 224,000, so I just went ahead and brought that 24,000 down. And then in step 4, the wage capital investment limitation amount of $8,000, which is the greater of these two values, 50% of the wages, or the sum of 25% of the wages and 2.5% of the unadjusted basis of property again. And I'm going to bring down that 8,000, the greater of the two, and I'll just carry that over to the right here, to the right column. Step 5, calculate 20% of the taxable and modified taxable income for the QBI deduction. So in this case, I'm going to take the qualified business percentage of 20%, and I'll multiply that by the taxable and modified taxable income of $375. And I wind up with $75,000. Calculate the lesser of the initial QBI or the 20% of MTI, which is the 8,000. 8,000 is less than the 75,000. And then finally, then, as we calculate down in step 7, what is the excess? The excess is going to be the initial 24,000 we calculated less the $8,000 reduction, because that's the applicable limitation. That's the applicable combination of 50% of the wages. So therefore, we can deduct the 8,000 from the 24,000, and we wind up then with 16,000. Now we have to apply that reduction ratio, and again, that reduction ratio is going to be 375,000 minus 315 divided by 100,000. And that gives us $9,600, and we'll just net that $9,600, a reduction because of their income limits, out of the 16,000 that we calculated in step 7. And that winds up then with a final QBI deduction amount of $14,400. So again, this is very convoluted. There's many steps to this. I would just use the template, replay the video if needed, and use a template I posted to Blackboard to kind of run through these calculations. And if you read the notes that I have listed in each cell, that will really help to illuminate and to explain a lot of the calculations and the reasoning behind those calculations.